Okay, hello everybody, and welcome to Investing with IBD for August 14th, 2019. I'm your host, Arusha Pierce, and with me in the studio today is Amy Smith.
Hi, Arusha.
She's a national speaker, author, former host of the IBD Investing Show.
Mm-hmm.
She was
with Matt.
the original gangster.
The co with my buddy Matt.
Yeah, exactly,
Yes.
Matt Galgani. And also the market wrap videos, too.
Yes.
You did that for a number of years.
Mm-hmm.
So it's great to have you here, Amy.
Oh, well, thank you for having me. And you have me on a day when the Dow's down 800.
Oh, yeah, no, that's perfect
I want to
timing.
be exciting, right, to come in and talk about it.
Exactly. On today's podcast, we're going to talk about, unfortunately, we'll talk a little bit about the markets.
Yes.
But we'll talk about investing at a black belt level. And we will, of course, end the episode with a few current stocks. But before we get into the market, because I know, Amy, you love talking about when the markets, when they're down 800 on the Dow, let's get into your background and how you got into investing. Because you've been doing this for a long time. We've known each other for a long time. Yeah,
we
before
have been.
IBD.
Right.
But how did you get into IBD and into investing?
In the strangest way that you would never believe, of course. So I was doing a lot of fitness training. And someone asked me about this product called Relive. Now, there's 1,000 supplements on the market now, but at the time, it was kind of one of the early ones. So I went and I said, well, I don't know, it's traded on the stock exchange. I guess I better go look something up about it. So I went to the newsstand, and there was an IBD there. And I said, oh, Investors Business Daily. Okay, so I picked it up. And inside, when I was looking up, because I had no idea, ticker symbols, how to look stuff up, nothing at all. So there was an ad. Come see Bill O'Neill free. There was an event in the Valley. And so I went, and then everything made sense to me, like every single thing that he said about the stock market. But it was good for me because my slate was clean. Mm-hmm. I didn't have like value investing in my head. It was really a clean slate. So I believed everything that he said.
Yeah.
And I took my pen. He made us mark up the paper. He made us circle parts in the paper like new highs,
That's
stocks that were
awesome.
breaking out. And of course, this was the 90s. So I went home. And I said, oh, my God, this works. This is so fabulous. It really works. And my husband said, this is amazing. And that went all the way till the year 2000. And then we know what happened in 2000. And then I had to go back and really learn. I think at that point, weren't we both on the same curve there?
Yeah.
We had to really go back and learn how to invest, really read the charts, really do the work, because it wasn't just stocks making new highs and all the tech names and everything. It got a lot harder after that.
Oh, yeah. 2000 was a nice wake-up call. It's
Yes,
like, wait a
it
minute. You mean the stocks don't always go up?
Go up, I know. Wait, what happened to my portfolio?
Right, exactly.
Yeah, right. And then, it was weird. So I joined Santa Monica Meetup, and that's how you and I met. And we were there for years and years and years together. And one time, Bill O'Neill came, and I was helping out up front. Mike Scott was presenting. And so Bill was in the back, and he said, is that Bill O'Neill back there? Is that Bill?
Yeah,
and
he didn't tell anyone.
No,
that he's gonna,
he just showed up.
He just showed up like an attendee
He did.
and sat in the back.
In the back,
right?
but everybody recognized him. And so there was like this murmur that went through the meetup, that Bill was there. And so anyway, we talked for a long, long time outside. I got to know him a little bit. Then I got to know, the MarketSmith folks used to use Santa Monica Meetup as the guinea pigs quite a bit for testing. So I got to know a lot of people here at IBD. And one day they called me and they said, would you like a job? And I said, well, I'm enjoying investing. And they said, well, you can do both. Why don't you come here and do both? So that's how I ended up here.
And one of your jobs was to help grow the meetups.
Yeah.
Right.
So Bill and I, that was, looking back on it, when you're working so hard, you don't realize how much you're learning.
Right.
But opening up the 50 meetups with Bill and hearing him speak repeatedly over and over again, it was the repetition of that it was an amazing time of learning. And plus, I got to spend so much time with Bill and look at charts and talk about stuff. So we opened up 50, and then we started attacking, the whole U.S. along with my previous coworker here that opened up a lot. So yeah, opening the meetups is a lot of fun too.
Yeah, and then you wrote a book. You wrote the How to Make Money in Stocks Success Stories. What was that? That was in
about
2011.
Yes,
around there.
So if you have a suggestion, be careful if you go to your boss and you suggest something to them. and they like the idea because then you have to go do it. You have to go write the book. I said, Bill, we've never written about our success stories.
Yeah.
And so let's write about the people that have done so well. And I said, I wanted beginners, intermediate, advanced people, hedge fund managers. And, it just ended up, he said, I love the idea, go do it. So I wrote this book in 4 months.
Wow.
Yeah, which meant I was working here full time, and I went home at night, and I wrote, and I researched, and so it was a fast 4 months.
And it was a great learning lesson because a lot of the people you spoke to in the book, right, who were interviewed, great learning lessons there.
Yeah, there are.
And a lot of times the best way to learn is to learn from others who are along the path. Not always at the top. They've reached the peak,
right.
But they're along that path and they're stumbling and learning from the mistakes, and you can learn along with them. So it's
Absolutely.
a great book. If you don't have it, it's the one that can help you get through the learning curve a little bit quicker.
And you get to see what mistakes they made. And, how you can correct your own mistakes and what they've been through. And there's some really great lessons in the book. So I was very privileged to feel like I got a chance to do it. And it was a lot of fun.
Definitely.
Yeah.
Now let's talk about something that's not as much fun.
Okay.
Today.
Are we moving into the
we
markets?
are. Well, that was my little
segue.
segue.
Yeah. Got it.
So the markets weren't very fun today, and so the most indexes were down 3%.
Yes,
or so. But what made them even less fun was yesterday.
We had a follow-through day.
Exactly.
Now, this looked like a textbook follow-through day, too, because the NASDAQ was up 1.95%, S&P was up 2.2%. We had volume higher across the board. All of the major indexes were up. It looked like it was it was a good follow-through day,
right.
with a couple of exceptions that I'm going to get into because I didn't buy it.
Yeah, I wish I could say the same thing, but I did buy it. But really, just to make sure everyone's on the same page, the follow-through day is a signal that, okay, maybe the markets are starting a new uptrend here, and so this is the signal we look for. Now, as we all learn, not all follow-through days are going to work. But if there are things to buy, if there's something to buy, you want to put some money to work so you get that feedback. And unfortunately, if you put some money to work yesterday, you got a little bit of that feedback today to the negative downside.
You got the
feedback. Oh, no,
exactly.
maybe we're not in an uptrend.
Yes.
So we had a distribution day.
We did. On the NASDAQ.
On the NASDAQ, we had a distribution day. And usually when you get a distribution day in the first 3 days after follow-through day, it decreases the odds of it
succeeding.
Mm-hmm. And then also I was talking to Justin Nielsen, who's been on the podcast a number of times, and he was the longtime assistant of Bill O'Neill.
Right.
He's learned a lot. For their market school study that they did over studying follow-through days and distributions and all that stuff, he told me today that if you have the next day, if it undercuts the low of that follow-through day, that's also another reason to be more cautious at this point. So the odds of this follow-through day actually working are definitely less. Does not necessarily mean that's 100% going to fail, but you want to be a little bit more cautious and make sure you're more on the sidelines than not.
Well, and this has been really a choppy news-driven market anyway. You could say kind of it's tweet-driven. You could say that it's been tariff-driven. It's been able to turn on a dime. Part of the problem was, even with the follow-through day yesterday, the NASDAQ was still hitting that resistance at the 50-day. The NASDAQ was below 8,000. We had this light volume recovery, and I wanted to kind of speak to that. That's not necessarily, I've seen on some of the threads people discussing that, we sold off. If you take a look, for instance, of the chart in the NASDAQ, you can see the much heavier sell-off, and on the way up, we haven't had as much upside volume.
Yeah.
However, if you go back to December when we took off the bottom, look at the volume. We're looking at our charts right here, you can see the heavy volume sell-off, and we did not get the upside volume that you would anticipate on the way up. So an uptrend can work even though you don't have continued upside volume. True.
Now, with at the end of December, that was really kind of a third wave down.
It was.
And so you had, even that, when we had that from September to December of 2018, there were 2 fall-through days that failed, and then the third one worked.
Right.
And so then it was rallying on lower volume there. But you really had, in the end, that third kind of wave down where you went into with December 24th, the Christmas Eve massacre,
Exactly,
right? Where
right.
you really had kind of a capitulation. Everyone threw in the towel at that
Right,
point.
at that point.
Here we're kind of still new highs and stuff like that. So
It's a little bit different. The other thing that you see when we came off the bottom in December, you know, part of it is we look at how many stocks in the entire market are really working and how many stocks are taking off. And, you know, I have to say yesterday, you know, we're supposed to buy something on the follow-through day. We had 0 stocks on the MarketSmith screens that we run, 0 stocks breaking out. Near the pivot, we had only 5
Right. It
that
was
are
pretty
close.
low.
It was
Yeah.
really a lean group of stocks.
Yeah.
The recent breakout screen that we run in MarketSmith came up with 15 stocks. And even though those aren't really falling apart, they're not making a lot of headway either. So that tells you what's going on in the general market.
Yeah. So you had that. Now, another thing was that with that correction that we had, and maybe we're going to continue this correction, it wasn't a long correction.
Right.
It was a short amount of time. So it wasn't a lot of times to build basis. But
Right.
now maybe we take
Now
another
maybe-
leg down. Another leg down. Maybe have more time to build basis.
Well, Lee Tanner, of course, Moses of the meetups that we know, he pointed out that there have been 6, this is a little bit outside of CanSim, but there's been 6 Hindenburg omens in the last couple of weeks. And that's an indicator of how many stocks are making new highs and new lows.
Oh, okay.
So what you have is a really bifurcated market, and that means that there's indecision. So you have some stocks making new highs. You have a whole group of others making new lows.
Right.
It doesn't show that the professional investors are really convinced which way to go in the current market. So I just thought that was kind of interesting.
Yeah, stock pickers market. I think
Yeah.
that's for sure. It's a narrowing leadership, so you have to be that much better at picking the stocks. But good news is that when you're studying this system, CanSim does a great job at identifying those leading stocks.
Absolutely. And, you know, people should not walk away just because the market's choppy, because you and I both know it can turn on a dime. A lot of things can happen. You know, there's been a lot of talk about the inverted yield curve, but even with the yield curve did invert, we usually have about 22 months, even if we're going to go into a recession. The average is 22 months. We have a good market before we get into a recession. So people should not walk away now if we still have 22 months, theoretically.
Right.
There's still a lot of
Now the
time.
nice thing is when you look at price and volume every day and every week, you don't necessarily have to worry about those larger macro. You keep it in the back of your mind, but you still let the market tell you what to do.
Yes.
Because if we get that fall through day again, or say we take another leg down, then we get another fall through day.
Yes.
Guess what? I'll try it again if there's something to buy.
Right.
You know, because one of those are going to work, and then you start getting that feedback.
Yes.
Onto the upside.
Absolutely. We're not going to talk about the inverted yield curve, but unfortunately, it has been accurate the last 50 years.
Oh yeah.
So this is something that
right.
we do have to watch and pay attention to, but it doesn't mean that we just go away from the market. That's usually what happens. People get worn out, and about the time they get worn out, as you just mentioned, in December, then that's when the market will take off again. So it's a good time to study, too. If the market is choppy, it's a good time to go, do all your work, get caught up, keep your watch list up to date.
Perfect.
Yeah.
So the market right now is under pressure, and we're not. We're in that indecisive moment that Amy's been talking about right here. Next couple of weeks are going to be critical to see if
Yes.
this rally can regain its footing or we take the next leg down.
Absolutely.
So let's take a quick break. But when we return, we're going to talk about what we need to do for all of us. What we need to do to take our investing to the next level. Stay tuned. Hey everyone, it's Arusha here. Now first, I want to thank everyone for listening to the show. We are always interested in hearing your feedback, and we've created a survey to get your thoughts. We want to know what you like about the show, what you don't like about the show, and also how we can improve. So if you're interested in taking this survey, please go to investors.com/podcast survey to give us your thoughts. We're back with Amy Smith on Investing with IBD. So, Amy, let's get into investing and how you get to a black belt level.
Which, of course, we know that we all want to be. Well, one of the themes, my kids were both black belts. They are black belts in Taekwondo. So I decided that to write the book, I would do, well, what about if we were like white belt investors and then yellow belts, and we do our testing, and we go up, and then we become black belt investors. And, of course, those are at the very end. I have hedge fund managers and people like that. So how do we become black belts? Well, I guess the first thing that we all do is we have to study. But I thought this Muhammad Ali quote is in my book. Champions aren't made in gyms. Champions are made from something they have deep inside them, a desire, a dream, a vision. They have to have the skill and the will, but the will must be stronger than the skill.
That's a perfect quote for investing.
Have to have that will.
You do,
power,
yeah. And hopefully that, everyone's having that will, especially with this disappointment over today, and it's not easy, especially these last number of months.
Right.
Hasn't been easy in the market. Yeah, and you do
Right.
have to have that will to kind of keep fighting through and knowing that there is going to be a better day, a better trend out there to make money.
And make sure that you have your rules and everything. I guess the first thing, I took different key points that some of the black belt investors said. First of all, there's a learning curve, so you have to dig in.
Yep.
You've got to do the work. You've got to do the education. If you're going to be a tennis player, this goes back to like what Bill always said to us, you have to practice. So the first thing would be to dig in and do the education and read the books. There is a learning curve, and always be prepared for the next great stock. So that's part of our routine to
Yep.
stay on top of things
Yep.
and things like that. Latch onto a big winner and ride it like Bill. Now, that's easier said than done, Rusha,
Definitely
right?
is. Yeah, that one is definitely easy.
That was the harder one.
Yeah, because it's funny. When you're going through that learning curve, the first couple of years, you're going to get down the buying part, right?
Right.
And you're going to be in a lot of these the next great growth stocks.
Right.
Like everyone else is.
It's just, can you hold
yeah,
it?
the managing,
It's
that's
a managing
the
it.
difference part.
Yeah, that's a hard part for everybody. Look for new trends. There's always some new trend out there. There always is. You have the shoes, solar technology. What are the gotta-have-it items? The Square. I would see the taxi drivers when I would travel using the Square on
Yeah.
top of their phone. So I
Yeah.
said, that's like everyone's using it. Uggs boots. I remember when my daughter was in middle school, and I was like, what are all those boots that everybody's wearing? She's like, those are Uggs. And I ran home, and I realized that Decker's Outdoor was selling them, and Decker's stock took off.
Yeah.
Because,
I remember when I moved to Los Angeles in 2007, I was from Boston. I couldn't believe that there were all these women walking around in Uggs boots.
Uggs boots.
Like, they're like the snow boots.
Yes.
Look like, it's like, why is everyone walking around in 85 degrees?
Because they're
And
cool. Because they're cool, Arusha. That's why.
Yeah, I had to learn that. That was my first LA lesson.
Triple-digit earnings, that was something that we keyed in here.
Yeah.
And, LinkedIn, for example, before it took off, it had 6 out of 7 quarters of triple-digit earnings and sales. So when you see a stock like that, those are the
rare,
rarefied ones.
Yep.
That's something to look for. Learn from your mistakes and missed opportunities. And, of course, that, I'm sure you've done lots of webinars on post-analysis.
Yeah, for sure. And definitely have made plenty of mistakes on that. And sometimes you have to make the mistakes over and over again.
Right.
Before you say, oh, there's probably a learning lesson here that I probably have to stop doing.
Right. Am I buying a little bit too early?
Exactly,
Am I
yeah.
selling a little bit too late?
Right.
Am I, what is it that I'm, do I have a pet stock that I've got to keep that I
Yeah.
won't let go of? So know when to go to cash or at least reduce your exposure, which, when you have a market like what we had today, there's cash is a position. And there's no harm in pulling back a little bit. If you buy something and it's not working, that's why we have sell rules,
Right.
so that it protects you and you're safe in the market.
Yeah, and the market's going to give you feedback all the time.
Yes.
You just have to learn to listen to the market. And
Right.
And in the beginning of the year, when the markets were trending well, you were right a lot. Anything you bought was going up for the most part.
Right.
Over the last few months, you've been wrong a lot more, or been struggling. It's been harder
Right.
to keep hitting new highs in your equity curve, and instead you're giving back, and you're giving a lot back at times too.
And that's what happens. I mean, you and I both have been doing this long enough. When it's easy in the beginning of a new uptrend, after you've had a correction, maybe a bear market, it seems like everything's working
Right.
and your investing is going well and the portfolio is looking great. And, the longer you are in the trend, it gets a little choppy
Yeah.
when you get to the top, and things are more difficult. So don't let that discourage you if that's been happening to you. Avoid emotional trading, this is why we have rules, because a day like today can make you extremely emotional.
Absolutely.
I mean, you can go, oh my God, the Dow's down so much. So you have to be careful about that. Know the story of a stock.
That's a big one.
That's
yeah.
a huge one.
Yeah, you're never going to hold on to a stock because there are going to be plenty of times where the markets are going to come in pretty hard.
Right.
But in the and that's the hardest part is not necessarily just one of your stocks pulling back. It's that all of your stocks pull back
Right.
at the same time. Right.
Exactly.
And so knowing what stocks to hold on to,
right,
and what stocks to cut.
Right.
That all comes down to understanding the stories, which ones are the game-changing
That's right.
ones.
That's right. We're going to have garden variety stocks, and I'm all for buying the garden variety ones.
Right.
But, what we're really looking for are the game changers. But the problem is you're not going to have a portfolio completely full of game changers. Right. I think you want to be cautious about that. Maybe you want to have some of the big cap 20 stocks so that your portfolio is a little bit more stable, which I guess that gets into more portfolio management. But speaking of the PMs, the portfolio managers, when I interviewed Mike and Charles, two of the elders here, when you enter a stock, always have a plan. And that's something, over the meetups, we talk about this a lot. When are you going to buy? When are you holding? When are you going to sell? What do you hope to gain? And of course, most of the time with CanSim, we know it's 20 to 25%. But, you may have a stock like Square, and you may not be taking profits at 20 to 25%. Because you realize you have a big winner on your hands.
Right.
So it's knowing how to handle those the bigger winning stocks.
Yeah, and it doesn't have to be all or none. If you have Square and you're up 20% and you want to take some,
right,
but you know that it's also a game-changing stock, take some off the table.
Take some, right.
Hold some, and now if it pulls back, at least you sold some.
Right.
And then that one goes up. Yeah, you still have some, right? And so at least that keeps you in the game, allows you to ebb and flow, and you don't have to be right all the time.
No, you don't. Bill, that's so funny. In most of my talks with him, he said, I was like a B or C student. I'm not a genius. So I think we could maybe debate that. But, he just said, I have my rules, and he does not. He can be wrong so many times in the market, and he just will sell. He'll come in and he would have talked with me about a stock and say, oh, what about so-and-so? I said, oh, that was 2 weeks ago. Like I'm on something else now.
Right.
So if it doesn't work, you just have to realize that and make the changes.
Yeah, let's get into that routine a little bit. So say we go into a correction right here.
Right.
Now, what's the normal reaction for a white belt or a yellow belt, right?
Right.
They're gonna put their head in the sand, or they're gonna walk away. Oh, this investing is hard.
Right.
Where someone who's more experienced realizes, I need to keep that routine. I need to keep doing my routine regardless of market environment.
It's better, it's funny. My kids went to Catholic grade school, and the principal used to say everybody does better with a routine, and be consistent about what you do. So I think even Jesse Livermore said that traders need to be like athletes in many ways. You watch your eating, you watch your exercising, you do your regular routine, and you just kind of keep doing it no matter what the market is doing.
So true.
Yeah, which is easier said than done. If between 2000 and 2003 was kind of a tough period of time.
Exactly.
But, okay, you already talked about some of this, assessing your strengths and your weaknesses. You were talking about some of the things when you do a post-analysis. Yeah. That's when we can see what our strengths and what our weaknesses are.
That's always the post-analysis is always the hardest thing, I think, from experience.
It's kind of painful to see what you did.
Yeah. You're like, what was I thinking?
But it was a good stock.
Yes, exactly.
It was a great stock.
Exactly. Why did I keep getting in and out of this stock?
Right.
And all stuff like that. Yeah.
Right. Detaching your ego from your trading, which is, we can go through a period of time where we're trading so well and like, oh, we're just trading so well. And then that can make your ego inflate. And, maybe you tell your spouse or somebody that you're doing well, which is a bad idea.
Right.
And then you kind of keep trying to do well instead of allowing what the market is going to give you.
Yep.
So you got to get your ego out of the way. The best traders are detached from their results. So even if you get 800% gain, try to detach yourself from that and focus on, another thing. Here's something that a lot of people talk about in the meetups, a written trading plan.
Yeah.
Do you have some of your rules written down?
Right. Yeah. So I do have a number of my rules written down. So you have to do that. It's kind of like goals too, right? Writing down your goals and all that.
Right.
So taking the time to do that is a big part, and then also following your rules.
Yes, you have to follow.
Right.
Well, you know what, Bill, when some of the guys were young, some of the young portfolio managers, he would have them take their written trading plan and read it every morning before the
Smart.
market opened.
Yeah.
So they were really in touch with what they were supposed to be
Right.
doing.
Yep.
Which is really great. Well, we could go on and on, I'm sure, about all of this. I mean, I thought about some other things. Maybe next time we talk about things I've learned from Bill.
Right.
Some of the things I've heard him speak so many times, some of those things. We could talk about some of the articles he did in the paper where he really took us through the things he's looking for.
Yeah. And in the end, it's not a surprise, right?
Right.
It doesn't matter if you're training or boxing or you're a martial artist.
Right.
Really, the core concepts are the same. You got to have good routines, good habits, and just those best practices, and
Right.
learn from mentors too.
Right.
And that's going to help you take it to the next level. And so, in investing, make sure you have those good routines down, good habits, that trading
Yes.
plan written down.
Yes.
And that you're going to start seeing that improvement when the markets are actually ready to hand out money.
That's
the markets
right.
are not always ready
That's right.
to hand out money. So remember, corrections are opportunities. So if we go back on a correction, they truly are opportunities as long as you're protecting yourself. So don't drift too
That's right.
far away when the markets are disappointing or things are going not as well.
And, I had one more tip. Some people always ask me, well, how do you know where the market is going? How do you know? If you go through the MarketSmith Growth 250, that's one great way to see what all the stocks are telling us. But another thing you can do is to go through the IBD, the list. Go through the IBD 50, the Big Cap 20, the sector leaders. Go through those lists and take a look. Are the stocks setting up in basis? Are they already extended? Are they trying to break out but not going anywhere? So they're fizzling. Does that mean there's a problem in the market? If these breakouts were working, that's how we know we have a successful follow-through day. We have a whole bunch of stocks. They're all taking off together. Stocks are breaking out. The indexes are working. That's when we're in a good rally.
Exactly. And that's going to tell us the environment,
Yes.
the underlying strength or weakness of the environment. So speaking of current stocks, they're going to come up next after this, so stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. Amy Smith is our guest on Investing with IBD. And so, Amy, let's take this a little bit further and get into some current stocks.
Some stocks, yes, absolutely. And there are some, we don't want to be negative Nancy's here. So
and this is where the opportunity is, right?
Exactly.
Which ones are holding
up
the best?
Exactly.
Yeah.
So and a lot of stocks actually did hold up today, which was was kind of positive. So the first stock we're going to look at is Roku Inc. And you want to tell us a little bit more about that?
Yeah.
Rich?
So ticker symbol is ROKU. And this is and there's this whole phenomenon this whole trend. You talked about trends in segment 2, the cord cutting trend.
Yes.
Right, over the last 7-8 years, everyone's cutting cable.
Right.
And all this stuff. And Roku is one of the beneficiaries of this. Where they have their little device that you can just plug into your TV. You can get a lot of these apps on it. They're kind of the neutral device.
Right.
So you're not necessarily committed to Apple or Amazon.
Right.
You can get your Netflix on it. So they've really built up a pretty strong following. It's pretty amazing. They were one of the first devices to come out. And then all of a sudden, Apple got into the space, Amazon got into the space, but Roku's kind of fended them off, and they
surprisingly
just have
in a crowded field,
a very crowded field. Yeah,
Disney. I mean, with so many of these different choices out here.
Yeah. So they made it their own. So when you think of cord cutting, you think of Roku a lot of times.
Right.
So they've developed this really strong brand name over the last number of years. They've integrated their services right into the TV, so you don't even need the devices anymore.
Right. By the way, I have one of those little devices. We have I think we have 4 different controllers to go back and forth on our TV.
Yeah.
So, it would be nice to not have 4.
Maybe Roku could solve some of those problems for you, Amy. So it's just an easy way to get access to a lot of your normal TV stations that you could get it before. They have been one of the best stocks in the market over the last 3-4 months. really over the last year when you look at their chart. But probably one of the best stocks over the last month or so.
Well, and what's kind of impressive here, Roosh, so we've got a consolidation, a first stage consolidation. We've got a breakout here in May 2019 of this year.
And so, yeah, they broke out on May 9th.
May 9th.
Right.
And then we had a nice run. It stayed well above the 50-day,
yep.
Holding nice and tightly above there. And then it really jumped up recently as it reported earnings. Now,
yep.
we have to comment here. There's a couple of stocks that we see once in a while. They do not have earnings numbers, but they have the sales numbers.
Yeah, actually, a lot of the cloud stocks this past year
right.
were
have
doing
had the
that.
sales numbers,
yeah.
not the earnings numbers. So we have a little bit outside of Can Slim here. Now, one thing I want to point out is when they reported earnings here, they had an earnings beat of 63%, and it is the earnings surprise that will cause these massive buyable gap ups.
Yep.
But this was a buyable gap up actually, even though it was in not a proper base, but it was pulling back to the 50-day, so you could have gotten it off the 50-day there. And, of course, we had massive volume that came in as the stock was moving higher. That's a sign of the institutional buying. And we have the accumulation distribution rating of an A-, which tells you that that's been under institutional buying. The only weakness here, even though it's a hot group as you were describing, Roosh, it's the group strength is a little bit weak. It's like a C-. Usually we have groups that are a little bit stronger than that.
Yeah.
But this is like the stock in the group. This is the one to look at.
That's true. They're in the leisure movies and related industry group, and out of 197, they're ranked 128. So so sometimes you have kind of the one star stock that can overcome everything. And, even though they're in the leisure movies group,
right,
they're probably not really with all the other members,
no,
right? Because they're more kind of the, like the gold rush. Everyone's going after the gold. The ones who made the money were the picks and shovels, right?
Yes.
They're the ones kind of like saying, it doesn't matter what program do you want to subscribe to, Netflix or Disney.
Right.
We can give them all to you.
All to you,
right?
yeah. And that solves a big problem. It really does. Now, this is also a newer IPO in September 2017. So oftentimes we will see, those newer IPOs there's some of the stocks that end up popping in the market.
Yep.
So this one is an interesting stock, and I wanted to point out here it had an up-down volume ratio of 1.8. You want to speak to that? It's something I look at MarketSmith all the time, and it's something that actually in my book, a lot of the real black belt investors said that they pay great attention to that up-down volume ratio. These are like the game changers.
Yeah.
These are the ones that are really on the move. So maybe tell us what the up-down volume is.
So it's looking at the up-down volume over the last 50 days. And so it's just putting in a easy ratio right there. And so 1.8 means that it's 80% more up volume than down volume on that. So you want over 1, so 1 or higher. Right. And so very consistent accumulation. So it's just that nice little snapshot, as opposed to like the accumulation distribution ratings over a quarter. It's over 13 weeks.
Right.
So different kind of time frames here. But, I really like that up-down volume ratio.
Yeah, I do too. And above a 1.2 shows positive demand.
Yes.
Yeah.
Yep.
So this was 1.8. That was well above that.
Right. Now, Roku is extended, so you want to make sure it comes with another base. Now, if we go into a correction, or if this correction continues, chances are Roku will probably come back in, maybe form another base there.
And that's when bases are formed, is during corrections. So, base building happens because of a correction. So corrections can be good things.
Exactly. So let's go to the second stock, SolarEdge, ticker symbol SEDG. And this is another stock that's done very, very well. It's one of these stocks that's saying correction. What correction?
Yeah, there's no correction. There's not even much of a back off today. I mean, this is another stock. This is up like 87% from the pivot in 79 days. This one also recently, within the last couple of weeks, had reported earnings.
Yep.
It had an earnings surprise of 13%. Again, I want to emphasize that earnings surprise, it's more than what Wall Street is expecting.
Yeah.
And that's when you see those buyable gap ups. That's usually what creates that. I love MarketSmith because I can just scroll my mouse over it and I get all this great information. We've had monster volume coming into the stock. Again, you've got your institutional buying. The accumulation distribution rating is an A. Your composite rating, the IBD all around, is 99 here. Now, in this, the energy solar, the relative strength for this market, this is an A+.
Yeah.
So these energy solar stocks have been doing well. But
it's pretty interesting with what's going on with the solar. So SolarEdge, they're like a number of these other solar stocks here. They're providers of like solar inverters, a number of the equipment in the solar, not necessarily just installing the solar panels, but some of the pieces, the components that go into the whole solar process. Now, another major competitor of theirs is Enphase. But one of the real catalysts and the reason why both Enphase and SolarEdge have done very, very well is because of the whole trade wars and the Chinese competition. Because there are a number of companies there that are providing these parts too. They've fallen off. There's no more competition because of the tariffs. Because of Huawei has been essentially put on the restricted list for everything. No one wants to take none of these installers, these solar installers, they don't want to take a chance of buying a Chinese product.
So this worked very well for SolarEdge.
For both SolarEdge and Enphase. So a lot of the U.S. solar companies have benefited quite a bit from these trade wars that are going on.
And
now SolarEdge isn't a U.S. based company; they're an Israeli company.
Right.
But as long as they're not a Chinese
company, right? They're not going to have the same tariffs. They also are really terrific at optimizing solar power. Yes. You know, it's the length of time that your solar panel works. It's not just a matter of harnessing the solar power. It's how long, even on a cloudy day, will it continue.
Right.
So they are a leader on optimizing that power.
It's huge. Yep. Yeah, making the best of that situation, that cloudy day.
That's right. Of what we have now. Here we have earnings and sales, maybe a little bit off the CanSlim edge here. However, this is kind of a turnaround story. They had a couple of quarters of negative earnings. They turned that around. They were up 15% in the most recent quarter. Sales were up 43%. So that's certainly, they're selling. If you see sales of 43%, they're selling their product.
They went on a great run in 2017 too.
Right.
They just this monster run. They kind of settled down, and now you have this larger kind of catalyst.
Right.
And that's what Wall Street sometimes does. We'll get these questions on, hey, this company doesn't have a lot of earnings. They have a lot of great sales, but, it's not really CanSlim.
Right.
Wall Street's not always waiting for everything to be perfect.
Right.
And
they're looking to the future.
Exactly. They're always looking out, and then they're realizing, hey, there's this larger catalyst. If these companies are restricted from this country, who are the beneficiaries, right? And so they're doing that kind of thought process. Then they're making the decisions, and you see it on the chart.
You do. And I want to point out here, the up-down volume ratio is 3.6.
That's a
huge number.
Yeah.
I want to just say that Jim Ropel, that I've interviewed in my book, of course, he's been to all of our workshops, I think 20 times or 25 times, I think. He bought Google. So now we're back in 2005. And the up-down volume ratio was 2.9, and that was just a large number. It really put him on notice that he needed to pay attention to Google and when it was really moving. So again, if we go back historically and we look at this up-down volume ratio, it's something we need to pay attention to. It's something we don't talk about as much. We talk about the accumulation distribution rating.
Yeah.
But the up-down volume, and 3.6 is a big number.
Yeah, no, that's a very big number. You don't see that too often.
Right.
Let's go to our third stock here, and this is CrowdStrike, ticker symbol CRWD. And they're another security stock.
They are.
Based on, built on cloud computing. So just like Zscaler and a few of the others that we've spoken about in the past, this is another exciting security stock that is benefiting from all the craziness that goes on the web.
It seems never ending.
Exactly. All the hacking out there. They love it.
Plug one problem, you get another problem over here. So
exactly.
This is a space that's not going away. This is a newer IPO, so we're paying attention to this one. It had its IPO in June of this year. This one has a 2.1 in terms of the up-down ratio. It's been kind of in a little bit of a range here, Arusha, as we look at it, sort of up and down a little bit more. The other two stocks that we've talked about were really rocket ships.
Yeah.
They really went up a lot. This one has it's been doing quite well.
Yes.
But it is holding, and it even held pretty well today.
Yeah. It broke out of an IPO base back in on July 19th, so it broke out of that. Currently 18% from it, so it's everything's going well. Obviously, now this is yet another tech stock that does not have earnings, but they have monster sales.
Monster sales.
Triple-digit sales.
So we have, even for the last 4 quarters here, we have 109%, 149%, 108%, and 103%. In terms of, those are monster sales. We just talked about the triple-digit earnings or sales, and they've got it.
Yep, and they're in a strong industry group. Now, this kind of threw me off right now because I just looked at the rank. It's 17 out of 197. I thought it would have been top 5.
The top, right.
You know, so
right.
But you know, they're in the same group as Zscaler, Okta, CyberArk, all these stocks that you should be pretty familiar with if you're looking at the IBD 50 and the big cap 20.
Well, and the group still has an A- rating in terms of our rating that's on here on MarketSmith. We have accumulation distribution of A+. So there's been some heavy buying power that's come into this stock, although it is a little bit young. It hasn't been trading all that long.
Yeah, well, we like new merchandise.
We do.
We want new companies that are coming out in the market. And if you don't buy that IPO base, which is there's always a little bit more risk on it, keep it on your watch list. Let it form a more traditional base, like a cup with handle.
Right.
And then that'll give you a chance to try it again.
Something worth noting here: there's only about 134 professional investors in this, but that's because it's a new name. It's a young name.
Yeah.
Whereas, Apple would have many thousands of funds that are in it. So when you see this, you say, well, gosh, that doesn't seem like there's very many funds in it. It's just because it's new.
It's new, yeah, and it takes a while for a lot of these funds to get interested and then also even start building positions.
Yes, absolutely. Absolutely.
So those are 3 stocks that have done well this year and continue to hang in there during this choppy market. Thanks, Amy, for being on the show. As always, it's great seeing you.
Oh, every show was lots of fun. I'll have to come back and bother you again.
Absolutely. That's it for this week on Investing with IBD. Next week, we are going to have Vernon Bice on the show. He's a portfolio manager at Lord Abbett. And we're going to talk about how they adapt the IBD concepts, all of these rules that we talk about, how they actually take them and adapt it to the institutional and mutual fund world. So that's it, and I'm Arusha Pierce, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.